4. So the aggressive sell will be 23 to 27. The focus is the direction of the E-mini. And the preferred sell would be 27 or better. If we can't crack the 12 to 16 area, okay to get long. Now that wasn't so hard, was it? But you can really do this homework once you become conversant in the methodology pretty damn fast. Any questions? Got existing home sales today to be less than 300,000. I think 293 is the forecast. I got my numbers down right here. The key is the direction of the E-mini today, and there's a lot of stuff floating around. The European Central Bank is going to cut its rates this week. Don't know. That's part of the rumor. Part of the rumor is $1.7 trillion will be put out for a specialized fund for the world to put European paper in its bailiwick. There's an article up there that would require China to do that. Europe and the United States are remiss to turn that kind of power over to China. I mean, if I were China, I would jump on this because you can control what 45% of the world's GDP by being their banker or lender, and you can get pretty much what you want out of them just through how you back the loans. So if I were in China, I think I'd be raising my hand out there saying, hey guys, need some help to put this deal together, and then China doesn't have to worry about building a big military or the rest of it. They can do what they need to do through interest rates and who gets loans and who doesn't get loans. Mark, I have no idea. I know our servers went down because we lost power. And there have been power interruptions to the CBOT floor over the years where they stopped trading for a while. There was when they could bring the markets back up, it would start trading again. So I haven't seen the announcements out of the CBOT because it trades electronically. There might be 3 or 4 guys standing around the monitors, and probably nobody standing around the monitors before the day session opens. That it's business as usual. So it was trading on Globex, but our servers are at the Board of Trade, and we lost power for the building. So Peter's got some input on that. But I mean, it's very infrequent, but there have been over the 30 years that I've been doing this, there have been several times when they've lost power to the floor and trading halts. So okay, everybody have this data? Okay, we'll move on to the E-mini then. My F3 and F4 screens don't start until 7:53. Interestingly, my IQ feed's good, I believe. Yeah, the IQ feed data came in on the E-mini fine, but I don't have that set up. We'll be looking at CQG data here. So once again, as traders, we have to be flexible. We have to absorb the slings and arrows of electronic trading. It's better than standing on the floor and getting yelled at, right? Okay, we're up some 17 points from Friday's close. Friday's close was actually, I had it at 29.75, basically 11.30. And remember these areas that we've been talking about, the spill started from 55, 57. And sovereign debt issues makes this market sell when it looks like they're stepping up, and the financials rallying when they supposedly have solved the sovereign debt problems, then everybody's happy and our market rallies back. But there is no solution yet. I mean, it's just a lot of rumors going around. And here we find ourselves, what's the high? It looks like 47. Okay, when you go back and look at a bar chart, again, the Fed doesn't mind the market selling. They just don't want the bottom to fall out of it and have a 1987 situation or this deal. I believe it was last summer when we dropped like 100 points in 3 or 4 minutes. They don't like that because it shows we don't have an orderly market. And it's really, really funny when you go talk to stock money managers about well, that one's not going to let me erase it for some reason. Stock money managers, they get all upset and are really, really bent out of shape about high frequency trading. But again, people just rail at, I mean, it's kind of like windmills out there. People really don't understand markets. A local, a high frequency trader, they're making money on one tick. They don't really care what the price is. It's not their world. Their world is providing liquidity or making short-term trades, etc. And when people get into trouble, they start looking for excuses or stuff that they don't like. And the first place you go look would be high frequency trading, and you blame your woes on them. But that's not the cause of the selling by the large institutions. The people that are dumping paper don't like the fundamentals for the U.S. economy. And that's just it in a nutshell. So because the economy is contracting, or at least stalled, or growth is slowing, earnings per share are under pressure, and ultimately earnings per share drive the indexes. So That's what we're really fighting right here, is earnings per share. And that ain't high frequency trading. It's not local stumping positions, the rest of it. F1, large institutions set the direction of the market by injecting capital into the market, which makes them go higher, or pulling capital out, which makes them go lower. Hedge funds will trade it either way. In a down market, hedge funds are adding capital to the market, and that exacerbates the selling. So your large institution, most of whom are allowed to carry some cash, they sell out all their positions, go to cash, market pulls back, they do a little buying to make sure that their investment standards are met, that they're so much invested, take a little more profits, and they're always in the market. And if the stock traded at $1, a stock they like traded at $1, then traded up to 50, they have positions all the way from $1 up to $50. So they can make profits on one, and then it just goes back and forth. So we're out here flailing away at really red flags, red herrings, and the rest of it. Markets go down because there's more sellers than buyers, and they go up because there's more buyers than sellers. And it doesn't matter if it's a high frequency one, or if it's a large institution, if it's a hedge fund. It's just pretty cut and dry. We'll just make this 25 to 27 with the volatility that we have these days. So we're pretty euphoric. This market's pretty darn high based on hope, rumors. So my guess is we might see a little selling off the opening. And if we can't crack this 27 to 30 area right here, then we can build value higher. This area right here, they usually get about halfway into it. So taking a shot at getting short in that 50 to 52 area makes sense just because of these single prints right here. Getting stops above 57, so 55, 57 would make some sense. Seeing how far it comes back down. And then on the buy side, first buy that's going to be up is probably our 33 to 35 that offers us an advantage right here than in our 25 to 27. So my guess is we've got a trading range. Best short would be in the 50 area. Best buy would be in the 25 to 27 area. And we'll see if that actually happens. So can sell the 48.50 to 51.50 area. That would allow them to get stops above the overnight session with a cover, at 35 or better, 35.50 or better. Getting started, I would rather buy lower. So preferred buy zone would be that 30 area plus or minus, but we might live with a 35.50 or better and pick it up from there. Any questions? Copy these numbers down. Let me know when you got them. Let's